Thank you, everybody. Today's call is to speak to our CDLI index, the Cliffwater Direct Lending Index, through June 30, 2023, with a focus on the second quarter of this year, but also covering the entire 18-plus year history of this index. Let me just first address the index itself, its composition. This is really the first and still only published index of the performance and characteristics of U.S. middle market loans or private debt. We launched this in 2015. It was backdated to September 30, 2004. And we were able to backdate and have confidence in the backdated information because all of it comes from the SEC and representing an unbiased loan sample of about 136 business development companies. Our index is comprised of over 13,000 loans representing $283 billion in assets as of June 30. That $283 billion represents approximately 25 to 35% of the entire middle market loan universe. Again, these BDCs are like a separate account, one of many buckets that middle market loan managers allocate to. So they're very similar to the loans that go into their private funds or separately managed accounts. The data comes from 10Ks and 10Qs and other SEC quarterly filings. Because of this database being maintained by the SEC and their requirements, this index suffers from no backfill bias, no self-reporting bias, and has 100% transparency. I'm starting to see some universes being put together on middle market loans, but generally those suffer severely from backfill bias and self-reporting bias. So all in all, I don't want to be critical of others' efforts. Are always appreciated, but we feel really good about our data set. The index itself is asset weighted, both in terms of the index returns and the fundamental data that we'll show you. The index is generally published with a 45 to 75 day lag from quarter end because of that's when the filings come out. We report four returns, total return, which is unlevered and gross of fees. So essentially, we want to get to the DNA of middle market loans, unaffected by fees or leverage. We report an income return, a realized gain or loss, and an unrealized gain or loss return series. I'll cover a number of characteristics of the index, yield, et cetera. We'll talk about that later. We also have two sub-indices. Our main index is called the CDLI. We also have a CDLI-S, which excludes the junior debt, just focusing on senior debt, and a venture-only debt index. Okay. Lender level data is available that comprises the indices. So in other words, when we aggregate the data underwritten by over 100 lenders, we're also able to analyze individual lender performance. So that's not the primary intent of our index. Just again, what is a middle market loan? This is the capital stack of a typical middle market firm. You look at the top there, enterprise value of $450 million, EBITDA of $50 million. In other words, it's selling at or valued at 9 times EBITDA. Most of the index is comprised, if you leave out the bank revolver, which is typically with a bank, but not always, and is generally small. The two primary sources of debt financing are the first lien and second lien. Okay, here we've modeled this at 200 million and 70 million respectively. Typically, we see two types of structures. On the left-hand side, we illustrate where we have separate senior loans and second lien mezzanine tranches. On the right-hand side, increasing popularity is the unitranche loan, single loan that really combines the characteristics of the senior and the mezzanine. About half of what we call senior debt is unitranche. The other half is the first lien senior loan only. I will say at the bottom, at today's rates, SOFR, which is the typical reference rate today, 3-month SOFR is at 5.35%. We're generally seeing the market today a spread of 6.25%, OID of about 2.5%. OID is original issue discount, which is generally amortized over the life of the loan. So all in, the financing in this example, and really reflective of the market today, it produces a yield of 12.40%. Now we're turning to the returns. Okay, I'm going to focus on performance. And basically, direct lending or senior secured lending is not difficult to understand. It's really comprised of three subcomponents together, producing the total return. The lion's share of performance comes from that top blue line. That's interest income. And over the 18 plus, almost 19-year history of the index, income has averaged 10.77% in the upper right-hand corner here. Okay, detracting from that income is realized losses. Okay, that's shown in red at the bottom here. Losses average 1.04% for the index per year, and you note it's pretty steady on the downside, as is income on the upside. The third component is unrealized gains and losses. We'll talk more about that, but that may be markups or markdowns over time, and basically they will reverse themselves over the average life of the average loan. Currently, it stands at minus 29 basis points over the life. Those three components, again dominated by interest income, produce the solid blue line. That's the total return. Again, gross of fees of 9.37% over the life of the index. Okay. If we look at performance as of the end of June, breaking down that 9.37 over the entire life from the September 2004 inception, basically you see pretty consistent returns at or around 9% per year. Okay, and basically the income component goes up and down a little bit, but it averages 10.77%. Recently, it's been high over the trailing year, 11%, trailing quarter, 2.889%. If you annualize that, that's over 12%. But it's generally within a confined range, and really over a long period of time, only affected by realized losses, averaging minus 1.04%. In the current quarter, realized losses were 30 basis points. If you annualize that, it's 120. So it was a little above average for the second quarter, and we'll talk more about that a little bit later. On slide 7 here, this is a glossary. I won't go through these items individually, but use terms you are not familiar with, turn back to slide 7, and you'll get the definition. We're very interested in yield. This is a yield product. It basically sells on its yield, and I just want to spend a couple minutes talking about really two yield definitions. Again, they're defined on the prior slide, but one is you're probably most familiar with is the yield to maturity. That for the index, the CDLI, that is shown in light blue. Okay, and the yield to maturity is the current yield plus an amortization of any discount, price discount, or premium to the maturity date. What I do is I generally first look at the current yield in black, which shown here over the history of the index. Today, for the CDLI, the current yield is 11.56%. Other people generally talk about the yield to maturity as opposed to the current yield. The yield to maturity takes any price difference from the current price to par. So typically that might be a discount. And it assumes that discount's going to close over a period to maturity. And it adds on top of the current yield that extra return that comes from a price discount being eliminated. Doing that gives you the yield to maturity calculation. That's in light blue. Okay. And at the end of June was 12.07%. I will say that bond managers always cite yield to maturity because yield to maturity is generally above current yield. So it makes it look better than it probably is. And the reason is the yield to maturity, the difference, okay, that price discount generally reflects the market's expectation for defaults and losses from defaults. So a yield to maturity calculation looks higher, but assumes there's going to be zero defaults. Anyway, for the CDLI, we show comparative indices. We show both of these calculations. On average, over the entire period, the yield has been 10.31% for the index. The yield to maturity has been about 1% higher at 11.33%. It's no coincidence that 1% difference is the credit loss rate over the average credit loss rate over the history of the index. If you look at levered loans, here we use the Morningstar LSTA 100 index, the 100 indicating the most liquid 100 or largest 100. Again, a couple observations. First observation is the yields are lower. I have the same scale here on the y-axis. The yields are lower, okay, indicating the private debt yield premium. I'll talk about more about that in a minute. But again, current yield and yield to maturity. The difference between a yield to maturity and current yield, again, is about 1%, and that is the average default rate or credit loss rate, credit loss rate for leveraged loans over the same history. So just for your reference, when anybody talks about yield or yield comparisons, first thing to make note of, are they talking about current yield or yield to maturity? Okay. And again, major point being the difference is generally equal to the historical credit loss rate. Let me just flip to the next page and focus here. So let's talk about current yield. I show three indices: the CDLI in blue, always higher. Compare that to high yield bonds, and a more appropriate comparison because it's also floating rate is the Morningstar LSTA index. Point here over time, it spreads different, vary over time, But basically, the yield advantage for middle market loans, private middle market loans, over comparable leverage loans is over 5%, 5.25% using current yield. In the case of, if you're using yield to maturity, that same difference, the advantage to middle market loans is 5.18%. So again, pretty much the same. I also throw in here the yield on and current yield on high yield bonds. They're a little bit different. They're fixed rate, so they can move in different directions because of changes in longer term treasury yields. So, but anyway, it provides a point of comparison. Here we're showing yield again. I'm showing a 4-year, trailing 1 year yields. I'll get it right. Over the entire history. They've averaged 10.75%. We cover that territory. I also wanted to show T-bills because middle market loans are priced on a reference rate, which is pretty close to the T-bill rate. It was LIBOR, now it's SOFR, plus the spread. And I just wanted to show that if you look at absolute yields, they look attractive. If you also look at them relative to T-bills, it's also attractive. In fact, over this entire period, the average yield spread over T-bills has been over 9%. Okay, which is, that's significant for any asset class. That's pretty much a huge number. Let me focus, covering income. Let me focus on the negative. That's realized losses. This shows the record of realized losses over the history of the index. These bars, these are rolling 4-quarter realized losses. And I said earlier, they average about 1%, 1.04% per year, but sometimes it can be heavy, sometimes it can be very light. And if you look here, you can see great financial crisis, the oil crisis, COVID, where you can get well above average realized losses. And then there are periods where there are no realized losses. It's a very quiet. Over this cumulative period, okay, this shows the cumulative loss. So if you bought the index at 100 in 2004, that 100 would have had cumulative losses of 17.8, or you would have ended up with principal not of 100, but your cost value would be 82. What would that be? 82.2. So, but it's somewhat jagged. Again, year by year, here I'm showing a comparison of the CDLI, which is towards the right-hand side here. Okay, well, I'm showing that's credit loss over this entire period, year by year, and I'm also comparing it against high yield bonds and levered loans. Now, with high yield bonds and levered loans, we have both default rates and recovery rates. Together, they produce the loss rate. With the CDLI middle market, it's not easy to break down defaults and recoveries. It's a little more complicated. But what you should do is compare this credit loss column. And then the far right-hand side, I show the loss rates for commercial banks in the middle market. It's something called commercial and industrial business loans. That's the term used by banks and regulators. And two things: focus at the bottom from inception. High yield bonds, higher losses, 1.49%, so about 1.5% there. And the higher loss rate is primarily because they're often subordinated loans. For leveraged loans, it's 92 basis points, about the same for the CDLI, 1.03. and commercial and industrial loans 2.30. So bottom line, I basically say high yield bonds have higher loss rates, okay, about 1.5. Levered loans, the lowest at about 1%. Middle market loans a little bit above that, depending on the measurement period. And banks have not been particularly good at credit management, at least if you look at charge-off rates from their filings. Now let me talk about unrealized losses. These are the markups and markdowns that don't represent actual losses, but these loans may be marked down from time to time. And there's a specific pattern in unrealized markdowns. And that is, if you look here, I've shown the rolling in green, the rolling unrealized gains or losses for the index. And then in red, I show realized losses. Okay, so what's the pattern? The pattern is that basically the independent valuation firms mark down the loans, the middle market loans are not traded, so they're valued by independent agents. They mark them down when the markets look very risky or are risky. They're marked down, and subsequent to those markdowns, that's when we see realized losses. So it's almost like a loan loss, a bank loan loss reserve. There's an anticipation, unrealized, but anticipation of losses. They mark down the loans. When there are actually impairments, would be the red line. These unrealized losses are reversed into realized gains and transferred to realized losses. Okay. So we saw that during the global financial crisis, the oil crisis, COVID, and now Russia. The point at the bottom is the valuation firms seem to do a really good job at estimating future realized losses or future defaults. In fact, they overestimate them. So basically realized losses, actual impairments, average about between 25% and 50% of the loan loss reserve, if you will. So some people question valuation of middle market loans. I can say statistically, it's the valuations end up being statistically very conservative. Now let's focus on total return. Again, if I'm an investor and I'm looking at total return on middle market loans, and I'm looking at return streams. Here I'm showing trailing 4-quarter return streams, basically very stable. Okay, and except for the great financial crisis, which was a 3 sigma event, I'm dealing with returns largely between 5 and 15%. Okay, and this includes what I would consider 1 sigma and 2 sigma. COVID would have been a 2 sigma event. The oil crisis, a 1 sigma event. Global financial crisis, 3 sigma. So I generally say, hey, if it's a 3 sigma, all hell breaks loose. You're going to have a negative return on middle market loans, but it's going to be single digit. Okay, it's not going to be like down 50% like the stock market was during the global financial crisis. If it's a 1 sigma like the oil crisis, you might deal with a mid-single digit return. In a 2 sigma like COVID, basically likely to something close to 0, but positive. If you look at, I'm just quickly showing I won't discuss this in any detail, but again, if you look at individual calendar year returns, most of the time, private debt is the winner. Let me just turn to talk about characteristics, get off returns and talk about characteristics. I talked a lot about realized losses. We can look at the potential for realized losses, looking at non-accruals, loans in a portfolio, in this case in our index, which are non-performing, have defaulted. So non-accruals associated with default, and we show it relative to cost value or par value and fair value. So basically, I focus on this gray, the bigger number, because this is the non-accruals, the fair value as a percent of the cost value, and this is the percent of the portfolio on the left-hand side that is in non-accrual status. So during the Great Financial Crisis, it got up to 6%. But generally, it averages about 2%, 2.4% of the portfolio, and currently it's at 1.4%. Okay, so right now, non-accruals are half their historic average, which basically means the index is healthier, much healthier than its average over the 18 plus years. Also, this black line is a recovery rate. Okay, default recovery is how much you recoup after default. It's hovered around pretty much around 50%. That's where it is today. If we look at the quality of the index, this is something to keep in mind. The black line, black columns at the bottom show the proportion of the index that's senior, as opposed to subordinated or other. And this has become a higher quality index over time. Currently, 80% of the index is senior, whether it's true senior or unitranche. Back during the financial crisis, it was less than 50%. So just understand that organically, this is the middle market. As banks have stepped out, they were providers of the senior debt, and alternative lenders stepped in, which we're measuring. Basically, overall quality has improved significantly. In terms of average maturity, basically the stated maturity is 5 to 7 years on these loans. Often M&A activity or changes in interest rates can cause prepayments. The effective life consequently can change depending on market circumstance. Most of the time, the effective maturity is about 3 years. Okay, if you look at this red line, that's the effective maturity, hovers around 3. During the financial crisis, it has stepped up. Okay, now it's over 5 years, which is something not necessarily of concern, but it does point to less liquidity in the index, or slower payback of principal. So this is something to watch. It's generally connected with M&A activity. Fran might talk about that, but basically M&A activity has been very low so far this year. It's starting to step up, which I think Fran will talk about. We expect this effective maturity to start going down at our next publication. Diversified by industry. Basically, the industry weights basically mirror corporate America, particularly the Russell 2000 industry weights. In terms of price, so here we're comparing index price for the CDLI against the high yield bond index and the leverage loan index. So again, if there were no price movements, everything was priced at cost or par, it would be 100. Generally, these loans trade slightly below 100, okay, because of anticipated credit losses. But you can see these lines basically line up. In other words, directionally, they're very much the same. They're always in the same proximity. sometimes in terms of amplitude, they differ. Generally, middle market loans are less risky because from a technical point of view, liquidity is not provided, whereas these other indices have technical trading volatility embedded in them. We also show volatility not only of the senior loans, we break it down into senior and subordinated. Obviously, as you'd expect, the subordinated loans are more volatile. Another indicator of stress is PIK income, payment in kind income. We track payment in kind income as a percent of total CDLI income. Overall, it's small, well less than 10%. So 10% would mean, hey, if the stated yield is 10%, 1% of that is PIK income. PIK income really has been a little bit higher post-COVID, but is starting to come down. Is currently at 7.03%. Lowest number in the last couple of years. We also, I won't touch on this, but for your reference, we have the senior index and the venture debt index. The senior index generally has a lower yield and lower performance against the CDLI because of the absence of second lien. The venture debt is generally a higher yield, higher return because the underlying borrower is generally more risky. With that mouthful, let me turn it over to Fran to talk about what's going on in the market today.
Thank you, Steve. So I'm just going to spend a bit of time outlining what we're seeing in the new issue deal environment and provide you all with an outlook on where the space is headed over the near to intermediate term. In recent weeks and months, investor sentiment has certainly improved, and the tone on the macro has firmed up, with both economists and market strategists feeling more confident in a soft landing scenario rather than a recession. This positive momentum is apparent now in the loan market, particularly in the direct lending market, which has become more risk-on in recent weeks. As strategists look across asset classes, it has become apparent that direct lending market offers one of the most attractive opportunities to capitalize on the current rate environment and market opportunity. That being said, risks are always present, and so I'm also going to touch a little bit about performance outlooks should the economy soften, which is still very much a risk. Whether you're a credit manager, a private equity shop, or an investor, from all angles, we're seeing increasing demand from folks that not only want exposure to the direct lending asset class, but almost are deeming having exposure as a staple or a necessity in order to stay relevant and capitalize on the current market opportunity. In both these charts, we want to highlight the impressive growth of this market over the last decade and highlight how that growth trajectory is only going to accelerate at a time when other asset classes are experiencing a moderation or even a decline in growth. So in the chart on the left, we can see here that the AUM within the CDLI index has grown at a more than 20% CAGR in the past 10 years. Whether it's been public BDCs, which cater to retail, private BDCs catering to institutional, or the newly launched and to date most successful vehicle, the perpetually private BDC, which has been catering to the massive wealth channel, private credit and direct lending growth has been impressive, particularly at a time when market conditions have been extremely challenging for most other asset classes. In our view, this growth is driven by three tailwinds in three major categories. The first is the needs of the issuer. Direct lending executions save on time and effort. Working directly with these lenders cuts down on heavy syndication timelines, flex provisions, expensive underwriting fees, the need for a public rating, and there's many other advantages. Direct lending institutions are far more flexible in the way that they can lend out their capital and are more reliable partners based on their diverse and sticky fundraising efforts, proving that they are superior to the CLO model of the syndicated market. The second major tailwind is driven by the investors. Investors are always seeking outsized yields coupled with low NAV volatility. And there are just so few places to obtain that, with direct lending at the top of the list. Meanwhile, wealth and retail are meaningfully underallocated to direct lending as an asset class. 40 Act vehicles have been a great solution to deliver low double-digit yields in the current market. Even better is investors are looking at their private credit exposure as the illiquid part of their portfolio, making it a longer-term set-it-and-forget-it investment, which has been creating stickiness and more stability in this market relative to what we've been seeing in the public markets. This makes direct lenders more predictable for borrowers. The last tailwind is driven by market dynamics. Banks are in retrenchment mode. Just 3 weeks ago, there was news on the banks with $100 billion in capital and up as being subject to more onerous capital requirements. Meanwhile, loan mutual funds are episodic and uncertain in their inflow-outflow profile, and the CLO market is still suffering from expensive liabilities, limiting their ability to tap that market. These end investors are subject to massive volatility, making them far less reliable on refinancings and new deals for borrowers. Obviously, the rising and consistent hold sizes of direct lenders are making them more reliable and relevant with each passing quarter and allowing them to do bigger and bigger deals. This is a long-term shift that will ultimately replace a meaningful portion of the institutional loan and bond markets. Case in point, looking in the chart on the right, it is only a matter of time before the private debt market has surpassed these markets in size. Growth in the public markets has not only stalled in the last 18 months, but dropped. The US high yield bond market today stands at 1.35 trillion. That's down nearly 200 billion from its peak 12 to 18 months ago, while the institutional loan index has shrunk modestly to 1.3 trillion from over 1.4 trillion in 2022. Flipping to the next slide, we can talk about deal flow. While folks are bullish on private credit, money continues to flow in, it is important for the supply environment to meet that demand to keep conditions balanced. As you can see by the chart on the left, the market has experienced a material slowdown in middle market and direct lending new issue in the first half of the year, driven by rate uncertainty, macro concerns, and a buyer-seller disconnect. It was very hard for deals to come together earlier this year. But so far in the third quarter, as the tone has improved, so too has deal flow. In fact, we've already tracked over 20 different mega deals in the direct lending market this quarter, whether they were new public to privates, carve-outs, large-scale refinancings, or incremental financings for add-on acquisitions. The market is picking up materially, and we do expect the fourth quarter to be more robust. Meanwhile, on the chart on the right, you can see the PE dry powder is at record levels at nearly 1.5 trillion. Yes, the buyout math has become much harder in this base rate environment, but sellers need to sell and return money back to their LPs. Buyers need and want to put this money to work. And so ultimately, buyers and sellers are likely to meet in the middle on both enterprise values and leverage levels, which is starting to happen. This dry powder also implies there is a long runway of opportunities for direct lenders to put money to work in attractive assets and deliver outsized yields to investors. Moving to the next slide, we can take a look at how the slower deal environment in the past 1 to 2 quarters, coupled with this improving market sentiment, has impacted pricing. While most managers have been touting on earnings calls how attractive the new issue environment has been in the last few weeks, which is certainly true, when you compare these pricing charts to 2022, we have seen spreads and pricing start to tighten again, as lenders have been aggressively competing to win mandates and demand has outpaced supply. Getting healthy allocations and winning the lead on a high-quality deal is becoming more difficult for managers. And with leverage somewhat capped on how high it can go to the base rate environment, most lenders are competing on price. Looking to the chart on the left, regular way, first lien, and unitranche sponsored back deals are graphed here, with spreads in the dark blue line have already tightened roughly 25 to 50 basis points relative to where we saw them in the first quarter at the height of the market dislocation. The good news is that spreads are still higher versus where we were in 2022, and this tightening is still relatively benign relative to what you're seeing in the institutional loan market in the gray line, where spreads have come down much faster. Meanwhile, some of the riskier parts of the market where lenders were completely risk off earlier this year, like non-sponsored lending or ARR loans, have regained momentum and spreads have come back down to more normalized levels, as you can see in the chart on the right, after shooting to record highs in 1Q23. I also want to highlight in the chart on the right, the gray bar, which illustrates large corporate direct lending deals, which we define as EBITDA greater than 125 million. These larger deals have experienced meaningful spread tightening in recent weeks. Most of the largest direct lenders are also the biggest fundraisers. And so as their flows have picked back up, these lenders are more aggressively looking to deploy capital into bigger transactions once again, coupled with the fact that their hold sizes have reverted after having coming down earlier this year. Currently, these deals are receiving pretty favorable executions, a big change from what we saw just a few months ago. Flipping to the next slide, we can pivot away from deal flow and talk a little bit more about borrower and portfolio health. One of the biggest positives for the asset class has been, to Steve's point earlier, the very low default environment, despite base rates being near 5.5%. So looking to the chart on the left, we actually saw the amount of new loans placed on non-accrual status in the second quarter after rising for 4 consecutive quarters in that light gray bluish bar. It actually declined. Now, while the market is cheering and correlating this to a stabilizing economy, it is important to note that if you dig into many of these loans that came off non-accrual, it wasn't because they went back to being current on their P&I payments, but rather they were restructured and turned into realized losses. Steve highlighted earlier in the presentation, realized losses are starting to pick back up and revert to the long-term average. But looking to the chart on the right, you can see the scorecard of how direct lending stacks up relative to BSL and high yield bond market. And the conclusions thus far have been favorable. Direct lending continues to have a lower default rate versus public markets, both on an LTM basis and also in the projections by objective third-party data providers through the remainder of 2023. Flipping to the next slide, we can discuss some of the drivers behind this positive portfolio performance. Investors, research analysts, they continue to see base rates rise, and they're continuing to question, why aren't defaults accelerating? Well, borrower strength is one important factor as to why the default environment has remained low. Despite very high base rates and interest costs, EBITDA has still been growing for borrowers in the leveraged loan market, as evidenced by the chart on the left, which represents quarterly EBITDA growth in the Morningstar LSTA index. Now, this only tracks a segment of the market where public financials are available, but it provides a good idea of the trend going on across a swath of sectors in the loan market. Coming out of both the GFC and COVID, we can see how strong the economy was in terms of growth driven by Fed stimulus. However, you can see that growth momentum is coming down quite fast this year because the Fed's raising rate policy to fight inflation is slowing growth. And of course, we can see how it is impacting interest coverage ratios on new direct lending deals in the chart on the right. While managers are highlighting that cash flow is still covering interest burdens, the cushion is eroding and is at half the level of what we saw 12 to 24 months ago, leaving borrowers with less wiggle room to navigate an exogenous shock or an adverse economic event. And so as Steve highlighted earlier, we should expect losses to pick up, and the realized gain environment that we benefited from for the past couple of quarters post-crisis is likely to slowly revert back to losses closer to the long-term average over the near to intermediate term. Now, moving to our last slide, I want to highlight some additional factors as to why defaults remain much lower in the direct lending market versus the public markets. You've heard so many managers on conference calls talk about how they believe their portfolios are more defensive in nature and better quality credits relative to the public markets. But talk is cheap. And so I wanted to actually show you some real stats on why they say that. We show you here, we took the CDLI index, we looked at non-accruals through time by industry. What you see in the chart on the left is the most common industries within the direct lending universe. In fact, these industries represent 85% of the portfolios of direct lenders, while the more tougher and cyclical industries on the right that typically have higher default rates make up a lesser 15% of portfolios back to 2017. This is a big reason why so many investors look at the headline default rates in the public bond and loan markets and they see deterioration and they ask, why is direct lending more muted? Why is it below the headline rates? In looking at the chart on the left, the data shows, we could break it down by sector. Manufacturing is probably the sector with the highest default risk within the most common sectors through time. As you can see, there was some pressure in the space pre-COVID. But manufacturing and industrial borrowers have actually been performing really well in the last 12 to 24 months, as many of these credits have had record high backlogs. They've been able to pass a lot of the cost of material and price inflationary increases through to the end client. Meanwhile, healthcare has certainly showed a modest spike during COVID as practice management businesses were shut down. And some of that pressure has continued into this year due to higher wage pressure and labor shortages. But the healthcare default rate still remains relatively low compared to what you're seeing on the right. Lastly, technology, which is the darling of the direct lending universe, has showed the lowest non-accrual rate back through time of all the sectors. It has been sub 50 basis points for the past 2 years, and it rarely climbs above 2 to 3% as you go back through time. And so in conclusion, direct lenders have been extremely thoughtful in terms of how they have built their portfolios to weather all types of market conditions while delivering pretty attractive returns to their investors. Yes, investors should expect to see losses pick up, but strategists agree performance issues shouldn't be comparable to what you're seeing in the public markets. And investors are continuing to benefit from the record high yield that on the assets that Steve highlighted earlier in the presentation. And so that concludes our prepared remarks. Thank you for your time. Steve, I'm going to turn it back to you to sign off.
Thanks, Fran. I hope our viewers have found this useful. We'll be back in November to talk about Q3 performance. Enjoy the rest of the summer. Bye-bye.